Hello, Professor. Can you hear us?
Yes, I can hear you. Good morning, or
Good.
good afternoon, or good day, wherever you are.
Good afternoon, sir. Last time you didn't hear us. We were
Oh,
talking
yeah.
too much.
So that is why today I couldn't say anything. I said, let me wait and see if you will hear ourselves today. That is very good. I'm so happy.
That's good.
Yeah, I'm so happy. Okay, so my strategy is I'm trying as much as possible to make sure we complete what we're supposed to complete. And then from there, we will move into two things as soon as we finish, because after this chapter, we have two more chapters to go, and then we'll have enough time to do review, and then enough time for us to work on our grades. Very, very important. So I want us to rush and finish this chapter, finish the next two chapters, and then we focus on the review of the entire course from the first chapter up to the end of the chapters. So that is my plan. And then, so two things will happen immediately we finish this chapter and the two chapters. Two things will happen. The first one will be we'll start rigorous reviews, and then we will also work on the grade. I will be working on the grade. Then if you have any question or if you look at the grades, if there is any missing items, you will let me know. So we will start doing that as soon as we finish this chapter, this chapter and the next chapter. So today we'll be looking at very, very important component of our study is the stockholders equity section. And we recall that stockholders equity sections is always on the liability side of our balance sheet. We completed everything about the asset sides, and we are finished everything about short-term and long-term loans and liabilities. So now we are on the tail end of our balance sheet, that is stockholders equity. So without much ado, we'll start with the first slide here. Let me see what it is. Okay, reporting and interpreting stockholders equity. Everybody see the screen? And one of you can say, yes, we've seen it. The screen is there. The last person who spoke to me. Have you seen the screen?
Yes, Professor.
So
Chapter 11,
you have you've seen chapter 11, reporting, interpreting, and interpreting stockholders equity, right?
Yes, Professor.
Okay, very good. So stockholders equity, we should know that these are the actual owners of the business. For example, Microsoft stockholders, they are the owners of Microsoft. How do we acquire ownership? Is by going to the stock market, buy shares of Microsoft, no matter how small, maybe 1 shares of Microsoft. Yeah, definitely you are also the owner of the Microsoft. You are one of the owners. So that is how it goes. So and then as the owner of Microsoft, you are very unlimited powers. You can enter into the management, make decisions about the corporation. You can influence so many things to happen in the organizations. And you have overall, you have what we call the voting rights. The voting right gives you right to vote your directors in and out, and also to appoint management to manage the organization. So you have some very, very unlimited powers. And then on the benefit side of it, you also entitled to a share of the profit at the end of the year in form of dividend. or stock options. So at the end of the year, they either declared dividend and say, okay, we have made so much money. The dividend declared is 10 million. So that 10 million will be shared among the stockholders. So we'll move into it proper, and then we look at the recording and the effects, because this is the financing aspect of the company. We see the effects of it on the cash flow of the company when shares are issued and when shares are repurchased or sold in both primary and secondary
Excuse me,
markets.
Professor.
Yes.
Regarding chapter 10, you said we will not take it, right?
What chapter?
10.
Chapter 10 is bonds. We may not go into bonds because not much is done by the company. Bonds is always really for pure finance. But if I have time, probably we'll just quickly review a little bit of it.
Oh,
because bond is just like a loan. The company can write a written instrument and sell it to the market. In form of a package, maybe in 10,000, 100,000, and over a duration, and then there must be interest aspects. So that is what we call bonds. But we will not, that may not be all that so relevant to us. You just know that for the capital structure of the firm or company, we have the ordinary share capital, we have loans, then we have all other short-term liability as well to make up this capital structure. Okay, so.
Oh, excuse me, sir. So
yeah.
chapter 10 is not included in our quiz or exam
It's
like
not
that?
No, I will not include it. Even if we have time to go over it, I will not include it in this.
Oh, okay.
We'll focus on, I think that is the second chapter we are skipping. We skip chapter 4 because it's all repetition, and then the bonds, I feel it's not what we should be doing as far as this course is concerned. But if you do pure finance, yes, bonds will be a very good, it will be a focal point, one of the points that should be discussed. But if we have time, I will just give you a note in a nutshell what it's all about, and then we move on. So it will not be part of our test or our final exams, but it's good. We'll just have a little bit of idea if I have the time. Okay, so for today, we'll look at stockholders' equity, explain the role of stock in the capital structure of a corporation. Capital structure of a corporation is the different mix of finance that make up the corporation itself. Different mix of finances, loan, ordinary stock capital, preferred stock capital, bonds, all those things, put them together is capital structure of the firm. The firm may have 10% loan, 20% equity, and maybe they have 80% preferred share capital. So when you put them together, that become 100% capital structure of a corporation. So we'll be looking at that. Then we compute and analyze earnings per share ratio. This is very, very important for the investors. They want to know what their share worth in terms of earnings. In terms of earnings, like when we look at the net profit, divide by the weighted average number of shares of the company. So we'll know what earning per share is. Then we describe the characteristics of common stock. Common stock, that is the ownership of the company, and report common stock transactions. How do we report it in terms of debit and credit? So we'll look at this report of dividends. Dividend is what the company declared to be paid. It depends on the company's policy. There is no formula that said, oh, this is how much the dividend that should be paid. The board of directors make decision after profit has been declared as to how much the dividend should be. Then we will now look at, another important ratio we'll be looking at is a dividend yield ratio. Dividend yield ratio, earning per share divided by the market value of that share, give us what we call dividend yield ratio. So we'll look at that too. It's very, very important because the stockholders want to compare what they are getting as dividend. More or less, some people depend on it as their only income or one of their income. Some people depend on it as income. And some people don't look at dividend as something very, very important why they should invest in a company. They may decide to look at what we call capital appreciation. Capital appreciation, how much is my capital appreciating every year? Because I'm not interested in dividend, because dividend, the government will tax me heavily. So I want to avoid that tax. So let me know what my share is worth. How much does it appreciate? So that's what they look at. So there are different motives of people investing in a company, depending on their preferences. So we report that. Then there is we also talk about stock dividend and stock splits. Company may decide to split their stock. How do we split their stock? The nominal value of the stock is $50, or they may say, okay, why don't we split it into $25 instead of making it $50, $25, and then issue the surplus stock to the existing shareholders. So describe information report and statement of stockholders' equity, yes. Then we will look at very important special stockholders, that is the preferred stockholders. Preferred stockholders, what I want you to know is that they are cut between loan. It's not like a loan, but at the same time, it's not like ordinary share capital. So they are able to take part of the characteristics of loan, part of the characteristics of ordinary stock, and make up what we call preferred stock. And when you look at it, what did they take from the loan part of it? The interest. The interest. Because for a preferred stock, that is a stated interest. And they have preference, they rank in preference to ordinary stockholder. That is the owner of the business. Before the owner of the business is paid dividend, you must pay the stockholders first. We'll look at that. And then finally, we'll look at stock transaction, the effect of stock transaction on cash flow. What are the stock transaction issuance? When the company issues stock, how does it affect cash flow? When company repurchase that stock, how does it affect cash flow? So that will be discussed on 11.9. So let's look at advantage of a corporation over a sole business. For a sole business, that's individual doing business. If it is not a corporation, they are exposed to unlimited liabilities. So if anything happens to them in terms of their transactions, or if they are owing any debt, the bank, for example, may go after the sole proprietor. Even their individual asset will also be included. And for sole, if you recall, in our very first lectures, the soles, they have a disadvantage of raising capital. They cannot, it's difficult to raise capital as sole. But for corporations, yes, they can raise large amount of capital in the stock market. They're just selling their shares. And also another thing is that the ownership of this stock, you can be purchased. When I open these lectures, you can buy one share of Microsoft, one share. You are also a co-owner of Microsoft if you just buy that one share, or 2 or 3, or 1 million, depending on how rich you are. So as soon as you buy those shares, you become the owner. So the advantage there is that you can buy small, depending on what you have, you can buy large. And your liability ends at the point of what you contributed is limited. That is why you can see that corporation has limited liabilities. Then the ownership interest also can be transferred easily. If you look at it, we have both what we call primary market and secondary market. And then when a company is raising capital for the very first time, a new company, the first thing they would do is to raise the IPO. IPO will be raised on the primary market, and then they will fix the nominal value of the shares and sell out the shares. That happened in the primary market. But because you purchase shares of Microsoft, you are a shareholder, and you may also transfer your share. Oh, okay. I have these 2 shares of ABC company worth $100, and I need $100. What do? You go to the market. Which market do you go in this case? You go to the secondary market. And the corporation that owns that share has no business in the secondary market to say, okay, you have sold your share, give us part of the money. No, you sold your shares, that you keep the money. It is yours. Yes. So that means there is a zero effect on cash flow of the corporation when the stockholders go to the secondary market to buy shares. So there is a zero effect on the cash flow. Like I said, the stock ownership provides investors limited liability. So liability is up to their contribution to the company. Their individual asset is not affected. Individually, nothing will happen to the assets. But for the soul, the converse is true. They have to make do of what they have to pay that debt, but at the same time, if it's not enough, the creditors or the finance company or the bank can enter into their assets. They can sell their houses, sell their cars to make do of the exposure. Okay, for stock equity section of the balance sheet, we know that the stock equity section, after short-term liability, long-term liability, the next will be the stockholders' equity. So for typical, this is Microsoft consolidated balance sheet. So stock equity, we have what we call common stock, paid and paid in capital shares. Authorized is 24,000. Outstanding is 7,571 and 7,643, respectively, for 2020 and 2029. Retained earnings also is reported under stockholders' equity section, retained earning. So for retained earning for 2020 for Microsoft is 34,566. In 2020 it's 24,150. So retained earning, you know what it is by now. That is appropriated out of income, net income. So instead of declaring all the profit as dividends, they retain part of it, and that appear on the stockholders' equity section. So then other comprehensive income also appear there. And then the stockholders' equity as at 2020 for Microsoft is 118,304 in millions. In millions. So that is the general picture of stockholders' equity section. And then let's look at the role of stock in the capital structure of a corporation, the role of stock. So corporations enjoy continuous existence, and because this is a corporation, it is a separate legal entity from the owners. So as a corporation is like that. I always say it's always a full human being. Corporation can sue anybody, can sue any company, and they can't be sued. So it's a full legal entity, and it's also a full human being. They can sue somebody, and somebody can sue them. So that is what corporation is all. So they enjoy that separate existence from its owners. So that means just like you individual, you have assets, you have liabilities, you can sue others and be sued. You can expand. You are asset based. You can expand how rich you are. You can also reduce your expansion, or you can reduce your assets. You can also contract independently. A corporation can go contract with a bank to get a loan, just like an individual. So a corporation is a full individual, So corporation is a full individual. So the benefit of stock ownership, for the benefit, that is what are the benefit to own Microsoft stock? You have a voice. You have a voice in the stock annual meeting. You have a voice in the management of the corporation. Another thing is benefit is that you can receive dividends. And we all know what dividend is. At the end of the year, you can receive dividend. And then you have residual claim, proportion share of the distribution of the asset. Residual claim, that is in case either the company is going to be winding up or the company is going to end. So if they sell all the assets, what is left, and then they pay their liability, what is left is what we call residual. So you can have residual claim on the asset of the corporation as a stockholder. So number one, you have a voice in the shareholders meeting, annual general meeting. In the management of the corporation, you have a voice, a very powerful voice. And then you are entitled to your dividends and then residual claim. Any questions so far? Any questions for me so far? No question. Okay, that means this section is this section is so easy. All right, so now we have some terminology. We don't have to mix it up. We have what we call authorized shares. We have issued shares, and then we have outstanding shares. Also, we have what we call unissued shares. Authorized share capital is usually the entire shares approved for the company by Security and Exchange Commission. It means, okay, based on your asset base or capital base, you have 20,000 shares authorized. So authorized is 20,000 shares, for example. You may decide to issue only 15,000. So 15,000 issued. And issued at times is not issued and fully paid. It may be issued and partially paid. Then if it is 15,000 issued, so what is left is 5,000. 5,000 is unissued. Is unissued. That can be issued on a later date if the company needs money. That can be issued on a later date. So you can see we have issued shares are the total number of shares sold in the stock market. And unissued are the shares that have never been sold, just like I've explained before. So the two put together give you what we call authorized share of the company. I'll give you authorized share of the company. So looking at it, you can see here issued shares, outstanding shares. We call them outstanding shares owned by the stockholders. And then it's split into two. We have what we call treasury shares. Treasury shares is what we call shares that have been repurchased by the company itself. There may be several reasons why the company want to go to the market and repurchase their shares. Just like you go to the market to buy Microsoft, Microsoft too can go to the market and buy their own shares. If they buy their shares, they are repurchasing their shares. And that will be under what we call treasury shares. Then we have unissued shares. So all this put together is called what we call authorized number of shares. Authorized numbers of shares. Authorized numbers of shares. So that is what we call authorized for the company. So we have outstanding shares. Those are the shares that have been issued. And the shares are with the shareholders, the owners of the business. And then we have what we call treasury shares. At that we call it treasury stock. So those are the shares that the company itself has gone to the market to repurchase due to companies, maybe as a result of companies' policy. And some of the hidden secret that I want you to note why at times companies want to go and repurchase their shares is that you know that share movement in the market is to the dictate of demand and supply. Demand and supply. So if Microsoft shares floating in the market is 100 shares, and the demand for these shares, that is the people who want to buy these shares, are just only 30 people, you will see that we have excess 70 shares. 70 shares is excess in the market, and that will drive down the market price. That is another thing. And also at times, because of the bad news from the company, the share price will start falling drastically. The market price of the shares will start falling right down. It keeps falling. So the best approach in most cases for company is to go in, repurchase some of those excess share capitals from the market to stabilize the price. So that's one of the hidden reasons that may not be in our textbook, but that is one of the hidden reasons why at times a company will step into the market to repurchase their shares. And that will give us, in economy, that will lead to what we call artificial scarcity. They will create that artificial scarcity. In that case, supposing 100 shares are floating in the market, only 30 buyers, the share price is falling, Microsoft now jump in and say, okay, I know we have 30, but maybe 30 buyers. So they can buy, say, 80 of those shares. So now, when they buy 80 of those shares, they have just 20 shares in the market, and 30 people need the 20 shares. So what will happen to the price? That will drive up the price of the shares, because 20 people are now chasing 20 number of shares. 20, 30 chasing 20. So you see that they have created what we call artificial scarcity. And in that case, the share price will go up, and the 30 people will keep going to bid. Oh, we need more shares. And it will not be there because they have been repurchased. So very, very important. There are other principal reasons why company choose to repurchase their shares. So many reasons. Not only that, but this is one of the hidden reasons I am explaining to you today. That one of the reasons may be because they want to stabilize the market price of their shares. So authorized, if you look at this Microsoft stock, common stock as at June 2020, authorized shares, 24,000 was authorized for them. But issued shares, so 7,571. This is the number of shares that have been issued, out of which none have been repurchased. So treasury shares or treasury stock is 0. So that means authorized issued here is 7,500. So that means if we go to the market in the stock market as of June 30th, the market is carrying 7,500 of Microsoft shares that are in the hands of the stockholders. They can go to the secondary market to sell those shares if they want, and that will mean just transfer of ownership from the person who is selling to a new stockholder. So we will move then to 11.2, how to compute and analyze earnings per share. You will see that in all the chapters, all the topics, we have some computation to do. We have to compute and analyze some of the ratios. Here, the first one is the earning per share ratio. After that, we'll look at dividend yield or dividend payout ratio too. So for earning per share is very clear. Net income, what has been made for the year. If we divide that by the weighted average number of common share outstanding, that will now give us what we call earnings per share. Supposing the company earns $200 earnings, and also the average number of common stock outstanding, that is what has been issued, is 100. So you will see that earning per share will be $2 for that company, based on my own example. That is $200 net income, and the weighted average number of shares outstanding, that is fully issued, those shares that are with the stockholders, is 100. So if you divide $200 by 100, you will have $2. So that means earning per share will be $2. So for every dollar that is invested, the companies bring back $2.15. So that means if you look at Microsoft and their close market rivals, IBM and Intel, you will see that in 2018, Microsoft earning per share was $2.15. IBM is $6.28. And in 2020, IBM was $6.28. Microsoft here is $5.82. And Intel is $4.98. So in terms of earning per share performance, you will see that IBM in 2020 was $6.28, better than Microsoft. So if you are going for earnings, and then you say, oh, this company is performing better in terms per share capital, why don't I go to IBM? So you have informed decision to say, okay, I go to IBM because IBM is making more money per share compared to Microsoft. But when you look at 2020, Microsoft and Intel. Intel is $4.98, and Microsoft is $5.82. You say, wow, I'll stay with Microsoft. I will go for Microsoft because their earnings per share is far superior to that of Intel. Okay, let's look at the characteristics of common stock and report common stock transactions. Okay, like we know, common stock, I mentioned this when in my opening, you have the voting right. You have these are their own benefit as the owners of the corporation. The voting right, very, very important. If they say they want to appoint the directors, they have the power to vote. And their vote is controlled by the number of shares held. If you are holding only one share of Microsoft, you just have one vote. So if you are holding 51% of Microsoft shares, 51%, so that means you have controlling interest, you have controlling votes. You can vote the management out, you can vote the directors, you can vote them out because it's the majority that carries the votes. So in that case, 51%, you can vote any of them out. And then you also, like we said, you share in the profit of the business through dividends. We now know what dividend is. That is the share. The share in the profit of the business. Like I said before, you can elect the board of directors. Board of directors, monitor the executive. Also, you can select who should run your business. So those are the very, very common powers of the owners of the corporation. Now, another thing we should look at the terminology. We always come across par value. Par value and market value. What are the differences? Very clear. Par value as at the time the company prepared to issue their shares. Based on their financial, they will be able to fix the par value. The par value may be 50 cents, that is 50 cents per share, or maybe $1 per share. $1 per share for average number of shares of 200, that would be $200. Initial issue, that is the par value. The market value depends on the dictate of the market. It may not. You can see here we say market value is not equal. The market value is not equal to the par value. It's very, very hard for them to be equal because the market value it depends on the movement in the stock market. The movement in the stock market. Just like one of the papers I wrote on the stock market movement of Saudi Arabia. If you type and Google it, you will see one of the papers I wrote on the movement of stock market in Saudi Arabia. Saudi Arabia stock market is Tadawul, and the movement of that market depending on some of the factors. I was able to analyze that. So if you Google it, probably you will see that paper. You can read it. Very, very important. It can help you understand more of the market value. And I was able to progress at the time. I wrote the paper that was in 2012. I was able to project the market price, the movement of the Tadawul market up to 2018. From 2012, if you read it, it's a good paper. Okay, so the market value is usually not equals to the par value. And now you know what the par value is, you know what the market value is. Okay, so initial sale of stock. I remember I mentioned initial public offering, that's IPO. A new company or a company that we want to start generating new capital. But let's also assume this is a new company. The company has never operated before. Now they want to operate as a public company. Maybe they were operating as a private company, but now they want to operate as a public company. Now, yeah, they will now prepare the offering, the public, that is the initial public offering, IPO, and then everything will be agreed upon and fixed. And then they will now go to the primary market and open their shares for sale. So now the market will start dictating what price, and then the market price maybe will dictate what they will actually fix. So if they fix, like for example, Microsoft shares, you can see here the par value, the par value is 0.0000625 par value of common stock. So if you look at the common stock of, if you want to buy a stock of which is now is 220 per share of common stock. So in that case, how will it go? So here in the price, here in debit will be, cash will be debited because cash is going to be taken for that initial offering, 220. And because they're selling it more than this par value of 0.000625, so their common stock will be reading $6 liabilities, while additional paid-in capital will be 290. The difference between these two will be the difference between 6 and 620 will be the additional paid-in capital. So looking at it in our equation, asset cash will be affected, 220 million. There is no liabilities because it was not a liability transaction, it was a stock equity transaction. So common stock will be 6, and additional paid-in capital will be 219,999,994. Okay, sale of stock in the secondary market. We talk about it, that the corporation has nothing to do with the secondary stock market, except they want to go in as investor too, like you and I, to buy the Microsoft stock. In that case, that would be repurchase. But in that case, if I have 10 shares and I want to sell, I will not go to the primary market. I will go to the stock market, the secondary market. There, the market price of Microsoft, that is what you are going to sell. You sell it at the market price, and then you obtain the funds. The funds come to you, not to the corporation, because the corporation has no part to play. When they issue the shares, they got their own payment. So in the secondary market, that is where shares are being traded. That is where shares are being traded in the market. Any question? Okay, if no question, I will keep going. So stock issue for employees too, and employees can be issued stock as a reward, as an option. As a reward, grant shares of stock to employees that vest on the future date. Vested on the future date. They can give them those, they can issue stock as an award. It's okay. You have 10,000 stock. And also those that performance are based on reward on stock. Also, they can issue them what we call stock options. Stock option is something like if the market price is $100 per share, the company may say, okay, this employee, they did so well, we will give them the option to buy this stock at a future date for $50, even though the market price is $100. So that's what we call stock options. Okay, so repurchase stock, we have talked a lot about it. That is the treasury stock or treasury shares. So the corporation repurchases stock from existing stockholder for a number of reasons. And you remember I told you one of the hidden reasons. It may be due to SEC regulations, and stock has been repurchased and is held by the issuing corporation. It's called the treasury stock, like I said. So it may be reissued treasury stock to avoid diluting existing shareholders' investment. So instead of issuing new stocks, creating new IPO, because if you create new IPO and issue new stock, you are going to dilute the actual earning per shares. Because if you have a 200 stock, company has 200, if they now issue new stock 250, supposing the earnings was say 400, so the earning will no longer be 400 over 200, earning per share will be $2 in this case, but because they issued new stock, that become dilution. So it will become 250. So if you divide 400 by 250, you will see that it will not give you exactly $2 again. Let me see. So it become 40 divided by 25. So that become $1.60. You can see. But when the stock was 200 and the earnings was the net income was 400, the stock price, the earning per share was $2. But because they issue additional stock, thereby diluting this stock earnings, so it become $1.60. So the company can also do that. Okay, for repurchase stock, you will see that when they repurchase stock, that is, they are buying back their stock, the treasury stock will carry a credit of 14 million. For example, if it is at $140 per share, while the treasury stock will be debited 14 million, and cash account will be credited because cash has been paid out. But when the items is now reissued, cash will be debited because money will be coming into the system, while the treasury stock and additional paid-in capital will be credited. So we stop here for 10 minutes and come back 5 past the hour. 5 past, okay, 5, 10, 15 minutes. We take 15-minute break and come back by 5 past the hour. So 15-minute break now, and we come back and continue our discussion on stockholders' equity. Okay, I'm way back. All right, so let's move quickly to learning objective. The next learning objective, but these are all repurchase reissued, how they affect debit and credit. I believe by now every one of you should be comfortable with the way the debit and credit works. So we go through learning, discussion, and report of dividends. So that we look at dividend payout ratio and how it is calculated. So the return from investment in a company is what we call the dividends. So dividends, there are a lot of policy, government, corporate policy on dividends, how much is being paid at dividends. And in most cases, companies don't pay everything out as dividend. They have to also have a portion of that net income as retained earnings. But then if you look at the profile of people that invest in the stock market and then as stockholders, majority of them are very wealthy. So, and then they have very, very high stock and high tax bracket. So in that case, they may not, like I mentioned earlier when I introduced this course or today's topic, they may not be interested in the dividend. Rather, they will be interested in capital appreciation. But for somebody like somebody who is retired, no other source of income, their main source of income probably will be they need very high dividend as income. So it depends on the motive and the position where you are. For very wealthy people with who are taxed heavily, they may not want dividend. They will expect capital appreciation. Let our investment continue to appreciate in value. Whereas a retiree with limited amount of income may prefer getting dividends. So they may take that dividend as their payments. So let's look at the key dates. A lot of people have been looking at dates. So, okay, they said this is ex-dividend, this is ex-dividend, this is date of record and so forth. So that we see it here now. Declaration and payment of dividend involve several key dates. The first one is the declaration date. That is the date after the income, the net income has been finalized and certified by the auditors. So now the board of directors will now sit down and say, okay, let us declare dividend. So the date where the dividend have been declared is what we call declaration date. So that date must be recorded and there must be journal entries. So a liability will be created and then also a debit to cash will be made. So date of record, that is the date of which the corporation prepared the list of all the stockholders. They call it date of records. So as at this date, if there are 10 shareholders, they will appear 10 of them under that date of records. And then date of payment is the actual payment date the cash is disbursed. So you will see that date of record is just looking at those who are to be paid dividend, those who own shares. So no journal entry is involved. There is no entry to be passed. You just get that list prepared. And in most cases these days we have computer. So computer will just generate that list immediately. In those days where there was no computer, they will manually now prepare a register of stockholders. as at that date. So the date of which the corporation prepared the list of current stockholders who receive the dividend payment, who will receive the dividend payment. So you can see there's a difference between those days when we don't have computer and now that we have computer. Computer will prepare that date, prepare the list almost automatically. So then the date of payment, you can see, that is the date when cash is disbursed. So you can see journal entry here, declaration date, the retained earnings, the dividend payable will be affected, the retained earning will be affected as well. And the date of record here, non-journal entry. They're just preparing lists of stockholders. And then we have date of payment. Date of payment, that is the actual date to you pass a journal entry. You pass your credit cash and then you debit dividend payable account, which is a liability account, you credit cash because money is leaving the organization. So like date of declaration, you can see date of declaration, Microsoft declared as of 2019, declared 3,886 million dividends for their shareholders. So the retained earnings now will be debited because retained earnings is where they will go to get the money. As at the time declaration was made, that money was provided and is in the retained earning. So now the debit retained earning and credited dividend payable, which is a liability account that is due within that same year. That is more or less like a short-term liability. So date of records, no entry, like I said, in this case, no entry is made. It's just a mere preparation of the list. But like I said, these days, computer is there. So it's not a big deal. In those days, it used to be a big deal. Because for a very big company with over 1 million or more shareholders, they have to prepare that list, that register, capturing the 1 million people or 2 million or 10 million as the case may be. But these days, in second, computer will prepare that list. So no entry is passed, no entry, because nothing has happened to the account. But on the date of payment, another journal entry will be passed. In that case, you debit dividend payable, you debit that account, and you credit cash because money, 3.8 million, is leaving the company. Cash is paid out, so you credit the cash and debit the dividend payable. Any question? No? Okay. So now let's look at dividend yield or dividend payout ratio, as we may call it. You have to know how to calculate that. Dividend yield is the dividend per share. So now if you calculate what dividend per share is, if 3 million, like the case, 3.8 million is declared. If you divide it by the total number of shares outstanding, you will get dividend per share. And if you divide that by the market price per share, you will be able to arrive at what the dividend yield is. And the better that ratio, the higher that ratio, the better. So if you look at Microsoft in 2020, it was 1.01%. And in 2020, for their competitors, IBM, it was 5.24. So more superior to Microsoft. And Intel was 2.82, which is more than double that of Microsoft in 2020. Okay, so impact of dividend on stock price. Also, we have what we call ex-dividend. Ex-dividend is the date 2 days before the date of record. 2 days. And 2 days before the date of record, that's the date where the compile the list. 2 days before that date is what we call ex-dividend date. And if you hold stock of a company that in 2 days will be paid dividend, then it will be foolish of you to sell your stock. Because if you sell your stock after that date, which is not permissible in the stock market anyway, then you are not going to earn the dividend. The dividend will pass to the new shareholders. So after holding the shares for almost 1 year, 3 days or 1 week to when the dividend is being declared, and then you are now going to sell your shares. So you will not benefit from the dividend. So we look at stock report dividend and stock split. Like I said, I introduced it before. I said, yeah, company may decide to split their stock depending, instead of paying out actual dividend, they may issue what we call stock dividends. They may issue what we call stock dividend in place of maybe the company is not having enough cash, so they may issue what we call stock dividends. Instead of paying cash, they issue stock in place of dividends. Okay, that is not very necessary. Let's look at this. Okay, stock dividends, return earnings. Assume Microsoft issue 40 million shares of its days per stock on the date of declaration. Date of declaration, the date they declare stock. So return earning will be 250,000 and common stock will take 250,000. So that is the date it was declared. Instead of paying dividend cash, they are now going to issue stock. Then we have what we call stock split. Like I introduced earlier, stock split, very clear. If the stock price is 50 cents, the company may decide to say, okay, we will split this stock. Instead of really going to increase number of shares, we split the stock. Instead of 50 cents, why don't we make it 25 cents? In that case, for every one stock you hold, they will give you one more stock. But that stock, so your two stock will be 50 cents, but each of them will now be 25 cents. That is what we call stock split. Okay, we will look at objective 11.7. Describe the information reported on the stockholders' equity. I think we have done a little bit of this previously. Those are the reports of looking at Microsoft. You can see the balance 78 million. Balance beginning of the period from the first day of the month, 78 million. Common stock issued is 1,343. These are the report, what you see in the balance sheet side of stockholders' equity. And you can see common stock there. A number of common stock, that is one, is not in dollars, the number of common stock, actual number of stocks. And then common stock repurchase. Now we know what repurchase is. We know what repurchase is. 4,599 have been repurchased. So that why it is, you can see it's in bracket. That means stock, their stock, issued stock has been reduced by that amount. So now the net of it will be 80 million. Okay, describe the currency. Now we look at another form of stock. In this case, it's preferred stock. At the beginning, when I introduced, I said preferred stock. They grabbed a little bit everything about a little very small characteristics of loan and characteristics of common stock. They look like loan because you pay a prescribed percentage of interest. They look like ordinary stock capital because you pay them dividend based on the dividend that have been declared, but they don't have the power of stockholders because they cannot vote. They cannot participate in the voting, so they cannot vote. But it is less risky for you to have preferred stock because the ranking of payment of dividend, you rank number one compared to, you rank first, let me put it that way, you rank first compared to the owners of the business, the ordinary stock. So you rank number one compared to ordinary stockholders. So you must get, as a preferred stock, must get paid before the ordinary shareholders get paid. So if a dividend is declared, maybe 2 million, preferred stock must get paid first before ordinary stockholder. So that is how the ranking will be. So preferred stock here, like I said, less risky. So typically does not have the voting right. You don't have the voting right, but typically has a fixed dividend rate. The dividend may be 6%, 10%, may be deemed as at the point the preferred stock was issued. So it's slightly different from ordinary stock capital, preferred stock, because they have no voting right, but they have fixed dividends. And they get paid first before the owners of the business. So that is why for an investor, it's less risky. Because if you are not paid, then the owners of the business cannot get paid. So preferred stock current dividend preference. So here, either they prefer the dividend or they prefer stock to be issued to them instead of dividend. And then we have what we call cumulative dividend preferences and non-cumulative. So if the dividend is declared this year, but it's not paid to the preference shareholders, they have the power of accumulating that dividend to next year. If they are entitled to $10 dividend this year, but it was not paid, and next year they're entitled to $5. So next year, if it is cumulative, then they should be paid $15 at the end of it all. So they will be paid cumulative. But if it is non-cumulative, the $10 was not paid because it's non-cumulative. As at the next year, $5 is declared, the $10 is completely lost. They will not get that $10 paid again because it is non-cumulative. So cumulative dividend require any unpaid dividend on preferred stockholders to accumulate. So this year, this year $10 was declared. Let me say last year $10 was declared but not paid. This year they have declared $5. So for cumulative preferred stockholder is entitled to $15 dividend. You must pay this $15 dividend. But if it is non-cumulative, the $10 is lost. Only what they will be charged will get will be $5. So that is the difference, the major difference, which I want you to note. Major difference between cumulative and non-cumulative dividends. Any questions so far? Okay, let's look at dividend. Yes.
Okay, sir. Now the question is under the non-cumulative dividend, assuming supposing one of the preference shareholder maybe he wasn't around to claim his entitlement, will it still go off like that, or the accountant will automatically?
No, the qualification. Okay, don't look at the definition of cumulative. Cumulative and non-cumulative. Cumulative this year, for cumulative, last year there is $10 dividend, but it was not paid. The company did not pay it for what, maybe due to one reason or the other. Maybe in most cases, they didn't have the fund. They didn't have the money to pay. So they did not pay that $10 for last year, 2021. And the 2022, $5 was to be paid. So they will be entitled to 15. But for non-cumulative, $10 was to be paid but not paid. This year, $5. But what are they entitled to? Only $5. The other $10 is gone because it's non-cumulative. But for somebody, for an investor who is a cumulative preferred stockholder, whether he is there or not, everything is these days is computer. I've given you my account, for example. So at the end of the year, I'm entitled to the $10, and then you did not pay it, including $5 not paid, but now $15 is outstanding. So anytime you are paying it, you credit it to my account, whether I'm showing my face there or not. I don't need to show my face in the company for you to pay me that as a cumulative member. But for non-cumulative preferred stockholders, the $10 is gone. The only thing I'm entitled to will be $5 to be paid. Whether I'm there or not, that $5 will be paid. Did I make myself clear?
Yes, sir.
Okay, all right. Okay, let's move to like a good example here. You see, assume the preferred stockholders is cumulative, that dividends have been in arrears for 2 years. So if dividends are in arrears for 2 years, yes, you can see here, your first one, 8,000 was declared. The 6% preferred stock, if you look at it, 6% preferred stock, how do we calculate that to lead to the 7,200? You will see that preferred stock 2,000 multiply, if you add plus 4,800 that was not paid, it becomes 7,200. So he is entitled to that 7,200 next year. It can see 8,000 was declared as dividend. If it is until they are paid this 7,200, common stockholder, the main owners of the business cannot get paid. And if they are paid, because 8,000 was declared, because they are paid 7,200, the only amount left now is $800. So that is the only thing that they will pay to common stockholders or the owners of the business. Okay, although not typical, some preferred stock has special voting too. For example, except from a public storage 2020 annual report. The holders of our preferred stock have general preference right with respect to liquidation. So on special issues, some of the preferred stock have voting right, but it must be clearly stated at the beginning. Otherwise, they don't have any voting rights. So that is what we should take note of. So if I ask what is the difference between ordinary stockholders, preferred stockholders, those are all those things I'm really trying to explain. Okay, the impact of stock transaction and cash flow. This is very, very clear. This stock transaction is more or less finance. If you recall, when we first introduced this course, we talked and said, what are the activities? What are the activities of the company? Is always three: operating activities, investing activities, financing activity. And stock transaction is generally investing activities. And what will happen to the impact of cash flow? Yes, if stock is issued for the first time, then that will be a positive cash flow into the system. Assuming IPO is prepared and they are selling stock to the market for 2 million. So that means 2 million is coming into the company in terms of cash. So that means we will debit cash 2 million, and then we credit ordinary stock capital 2 million. And if we are now going to repurchase, if the company is going to repurchase part of the stock that was issued, then that will reduce, it will reduce the cash, because they're now going to take cash out of their system to repurchase that stock. It will reduce cash, and what will happen, then there will be treasury stock created. That is just the impact. And if a stockholder want to sell his or her own share, it has nothing to do. It has no impact on the stock market. It has no impact. So that is the financing because it's financing activity, as I explained. Issues of common stock or preferred stock, that is positive cash flow. The issue for 2 million, 3 million. So that means we will debit cash 3 million and credit the respective stock 3 million. And what of common stock repurchase? If you repurchase, it will be a minus. It will be a minus to cash flow or to debit, to cash. So in that case, you credit cash. See? And now when you credit cash, you debit stock. And then sell, if you sell the stock, the treasury stock back, you sell it back. So in that case, you will get cash, and then the contract would be the debit. So you debit cash and credit the stock. In that case, that would be nil. Then payment of cash dividends. If we pay cash dividend, what happened to cash? Yeah, cash will be credited, and then you debit payment of dividend. So because cash is actually paid out. Anybody have a question? Okay, so that is in a nutshell how cash flow will be affected. Cash flow will be affected in that case. So that is exactly on the last slide what I've just explained. So if you understand what I've just explained, that is the impact of cash flow based on stock transactions. Is there any question? We have finished the lectures for today on stockholders' equity. We'll quickly run through. Now we are talking about cash flow. So we'll run through cash flow. When we come next week, and probably that same next week, we will finish the last part of it, the financial statement analysis that embrace all what we have done. How to prepare financial statement analysis, how to do a comprehensive statement analysis of the company. So probably we'll work on the cash flow, finish the cash flow quickly, because we have touched a little bit of cash flow. What is cash flow? Cash flow is the recording of transaction as per investment cash, operating cash flow, investment cash flow, and the financing cash flow, in and out, outflow and inflow. That is all what cash flow is. We'll not spend much time on cash flow, but you need to understand the impact of each of the transactions, how they affect the cash flow, because cash flow is the lifeblood of every company. So you need to understand that. Then we'll quickly run through that, and then we'll finish up with comprehensive statement analysis. That is the last chapter. We finish up comprehensive statement analysis. And as soon as we've done that, then upper week, we'll start our general review. And also I will have enough time now to start focusing on what is expected of your grades. So in that case, as I'm running through the grade, we're running the review. If you have any questions, feel free. If there is any error in the grade, you have enough time now to network with me, discuss, so that we make sure everything is fixed, so that whatever grade is there is the actual grade you earn. So any question? So like I said, next week we'll be looking at cash flow because we have been touching cash flow. Everything, every lecture we have done, we have talked about cash flows. Now we know that the cash flow we are looking at it embraces three activities: operating activities, investing activities, and financing activities. And each of these activities has what we call outflow, cash that are going out, and inflow, cash that are coming in. The net of the operating activities will give us the net inflow. It may be plus or minus. But like I said about ethical issues, we expect the net of operating cash flow to always be positive. That is the core business of the company. They are going to sell, maybe selling to make money or manufacture to make money. So operating activities can never be minus unless the company is running at huge losses. So now then investment activity may be plus or minus depending on how they operate. That is what they invest. If they invest on buying heavy machineries, a lot of machinery, yeah, it may be negative. But if they also sell some of their old assets and net it, it may be positive, it may be negative. And also financing activity may be positive and negative depending on the stock transaction. It may be positive or negative. So we'll be able to look at that within the next 1 hour or so next week, so that we now run into the core of the final chapter that we'll be looking at. That is comprehensive statement analysis. We'll be looking at the company. We use it to run through the analysis and see how analysts prepare the analysis and do their predictions. If you have any question, you ask me. Waiting for questions. Waiting for questions. No questions. So this professor have done a good job. Yes.
Okay, sir.
Yes, Professor,
This
thank
other,
you.
sir.
Yeah, one. Okay, you go first. Go first.
All right, sir. Sir, I want to find out. You talked. When it has to do with the stockholders' equity. Now, in the Microsoft company illustration you gave. So I want to find out if the retained earnings, in the company listed there is as a result of the cash flow from the financing activities.
The retained earning, the source of retained earning, by now, we should know it, is only one. The only source of retained earning is just one. First of all, net profit has been declared. Net profit has been declared for this year, as at the end of the year. Net profit, let's say net profit has been declared, the net profit for this company, after they have taken everything plus tax, the charge tax, the net profit is $2 million. $2 million. Okay? So now
Yes.
the company itself now will say, the company will now, based on the board of directors, they will now declare what we call the declaration date. On the declaration date, they will declare, so, okay, 2 million net profit, we are going to appropriate $600,000. Okay? So if they are going to appropriate $600,000 as dividends, so in this case, what do we have as retained earnings? The person who asked me the question.
It means that the retained earnings minus the amount declared for dividend.
Okay, dividend have been declared 600,000. The company net income is 2 million. So what will be the retained earnings now?
Is the net, I mean, the declared income plus the opening return earning.
No.
That is 600 first.
Net earning is 2 million. 600,000 have been declared as dividend. What would be the retained earning carried over to next year?
It will be minus 600.
Which is 1,400,000, correct?
Yes, sir.
Okay, so in this case, we have 1,400,000 retained earnings. So next year, whatever is left after the appropriation, if only 200 was left after they have paid, declared for dividend, whatever is left. So if whatever is left is 200,000, so the retained earning will move from 1,400,000 to 1,600,000. So this is how they build up retained earning. They can use it for something else later on, but for now, this is how they build it up. So retained earning is always left over of net income after appropriation. You know you know how we derive net income, correct?
Yes, sir.
Okay. Did I make myself clear?
Yes.
If it's not clear, tell me. I can still illustrate, but if it is clear, I will be a happy man if it is okay. So net earning comes from appropriation. The company may decide, let me quickly add this. The company may declare, it may make net income of 2 million and pay everything out as dividend, and then they have nothing left. So in that case, retained earning will be zero. But then a company that make so much money and pay everything out as dividend, that company don't stand the test of time. The company may shrink and possibly go dead. Because retained earning will help you either to revitalize your factory, revitalize your machineries, and also so many things that you can use that retained earning to do to move the company. You can also help you to expand your business. And that is the cheapest source of fund for a corporation because it is a zero interest, 0%. That's the cheapest. Going to take loan, probably they will pay 10, 20, 15% interest. And then if you take loan, a company take loan, it will be highly leveraged in the sense that you are taking loan. If something goes wrong, you don't pay the interest and the principal, the loan holders can come in and take over your company or sell your asset or sell the company. So you can see that the cheapest source will be your retained earning because it has zero impact, zero negative impact on your cash, on the company's position. Yes.
Okay, sir. So I want to find out if a company, after accumulating enough retained earnings, is it still necessary for them to still operate on preference shares or allow still go ahead to borrow money?
Oh, okay. That is a very good question. There is no way you can say a company has enough retained earnings because a company is a going concern. A company is a going concern. He may decide to expand because they have enough retained earning, and they may even decide to expand even more than what they have. In that case, they will need more capital to be injected into that system. So you cannot say the company have acquire enough. Even you as an individual, you have your own retained earning is what you keep for the rainy day. You're saving money. You may decide to say, okay, I have saved so far. Oh, wow, I've saved $2,000. I've saved $2,000. Now I can walk in and buy something for $2,000. But what if you now say, oh, but what I need to buy is about $3,500. You can see now what the difference now will be 1,500. That is when you will now say, okay, well, how will I finance this difference? You either go and take loan from the bank, or you call friends, or you call families. Please borrow me money, or give me money, or let me have a gift from you. So that is it. So the same thing as you operate as an individual, so also company. They may have retained earning about maybe 5 million in retained earnings. They want to expand, and the expansion involve about 8 million. So they cannot say, okay, well, we have only 5 million. Why don't we expand and limit it to 5 million? That is the policy of the company, which I don't want to be part of it. I'm not part of it to tell them, okay, this is what you should do. They know why they want to invest and expand up to 8 million. Probably more money will be coming in. Any other question?
Okay, sir. The aspect of you talk about the grading, sir.
Yes.
Okay, sir. I want to humbly ask, in terms when some of us miss some of the quiz, realize it,
Yeah,
it's time out. We are not able to submit. So yes, we are not able to submit. I don't know if there's still another grace period that can also help.
You mean you were not able to submit the last quiz too?
Yes.
But I give everybody, I say, the IT guy, I told him to increase it by increase it by 3 attempts. Make it 3 attempts. If you attempt the first one, you can attempt the second, you can attempt the third. And when you make 3 attempts, the highest score will be what the system will take. That is how I tell them to set it up, which they did. So that means if you make the first, even if you don't finish the first attempt, you make like 60%. Second attempt, you make like 40%. And then the third attempt, you make like 75%. Then the system will take 75%. If the first attempt you make 75%, and the second attempt 40%, and the third attempt 50%. So the system will now go back and take the first attempt 75%. So 3 attempts instead of 1 attempt. So if you did the first one, maybe because some of you complain of the power went off, because of that you couldn't, and you know when the power goes off, if it is only 1 attempt, there is no way you can go back and do it. But I made it possible to make it 3 attempts. If you tell me the power went off the first attempt, and went off the second attempt, and went off again the third attempt, then that is a problem. It's no more my problem.
Professor, in my own case, it's not, sir, in my own case, not that power went off the 3 occasions. It's just that I have a program at in the village. I lost someone, so going up and down. At times in the village, no network. I couldn't. For about 2 lectures, I couldn't attend the classes. And by the time I returned back to the city, the thing has time out. So I did not even make any attempts. Apart from even the initial one too, I was trying to. The first quiz, I was trying to attend that one, but network couldn't permit me to finish the question. Now, but this second provision, I was unable to even see or attempt. By the time I came back to the city, it was already time out, and I couldn't do that. Then on my own too, I don't know if any of my colleagues suffered that. That initial time, I told you that I couldn't upload, which you actually relax all other means of Excel. But the particular question, that assignment 1, because then you did not, it did not open that one. You only opened other ones, but that one I couldn't still submit it since that time, because when you open other assignment 2, 3, and 4, that one was not opened.
Okay. I will open that. Maybe I did not remember that. I will open that for you and anybody who did not turn it in. And then for quiz 1, I think it was only one attempt. Quiz 1 was only one attempt. For you, I will make it, give you another, I will give you an extension so that if you did not do it, you will do it. For those of you who have done quiz 1, even if I give extension, you will not be able to do it because it was first only one attempt. So I will open up, give everybody equal level, so that we all operate at equal level, have equal opportunity, so that if everything come out, you say, yeah, I was given fair attempt. So I'm going to open it, do the extension for quiz number 1, so that if you did not do it, you have opportunity to do the quiz. If you did not do it, you have opportunity to do it. Quiz number 2, if you did not do it, I'm going to extend it. The maximum number of attempts for quiz number 2, 3. 3 for 2.5 hours, which is even much. 2.5 hours for each attempt is much. So the maximum is 3. I'm going to extend it, maybe extend it by another few days, so that if you did not attempt it at all, you do the first attempt, do the second attempt, and then do the third attempt if you want. If you do the first attempt, you feel you are satisfied with the grade, you don't need the second and third. If you feel, okay, why don't I keep going until I hit the 100 marks? If you do the first attempt, you get 80, so okay, let me try the second one, maybe 90, maybe the third one, 95 or 100. The system will take 100. I want to give everybody, or place everybody on the same level of opportunity so that nobody will complain when the grades are finalized. So then we will have, next week, we will have just one more final assignment. It's not a quiz, it's not a test. Then we'll start working on reviewing the materials for our final exams.
Thank you, Professor.
Yeah. If there's any question asked, okay, nobody again. So if there is no more question, have a beautiful week. Review the material we have done so far. We have done up to, in fact, review up to the last chapter, because next week we'll do those, combine those 2 chapters so that we now have enough time for the review. So start reviewing those chapters for your final exams and then for your final assignment. Assignment will be on comprehensive financial statement analysis. Okay, all right. Thank you so much, and see you next week.
Thank you, Professor.
Thank you, Professor.
Thank you, sir.
Thank you,
sir. Bye.
Thank you, and bye.
Nice.
Okay.
Thank you, Prof. Thank you.